All right, welcome to The Explainer. We trust banks with our money pretty much every single day. But what happens when that trust just breaks? Today, we're going to dive into that really fragile system that holds our whole economy together and, how it came this close to completely falling apart.
So let's just jump right in with the big one, right? How did the entire financial system nearly collapse back in 2008? And look, this isn't just some boring history lesson. What happened then completely reshaped our economy. We're still feeling the aftershocks. So figuring out what went wrong, that's absolutely crucial for understanding where we are today.
Yeah, this was a system on the brink. And it wasn't just a case of a few bad apples, not at all. The entire system was failing. You probably remember those crazy images, the run on the bank at Northern Rock over in the UK. Just panicked customers lined up for blocks and blocks. Well, that was just a symptom of a much, much deeper sickness that was spreading like a virus through the whole global financial system.
Okay, so to really get to the bottom of how things went so wrong, we have to understand this fundamental tension that's at the heart of every single bank. It's this constant battle, this tug of war between making a profit and, well, staying safe.
This core idea has a fancy name, maturity transformation, but it's actually pretty simple when you break it down. Think about it like this. You put your paycheck in the bank, right? You might need that cash tomorrow. But what does the bank do? It turns around and lends that same money to someone else for a 30-year mortgage. See the problem? It's super profitable for the bank for sure, but there's a huge mismatch. They owe you your money back in the short term, but their money, the money they're owed, is locked up for decades.
And this slide, well, it lays out that banker's dilemma perfectly. It's all about that balancing act. On one side, you've got profitability. That means lending money out for long periods, holding on to assets you can't sell quickly like mortgages. That's where they make the big bucks on interest. But then, on the other side, you've got liquidity. Safety. That means having cash ready to go so you can pay depositors like you and me when we want our money. The catch? Cash doesn't really earn any profit. So it's this constant nerve-wracking tightrope walk.
So, all this talk about balancing acts and lending, it brings us to maybe one of the most surprising and misunderstood parts of this whole story. How is money actually created? Seriously, where does it come from? And I'm willing to bet the answer is not what you think.
Okay, get ready for this, because this is the mind-bending part. The vast majority of money in any country's economy isn't cash. It's not printed by the government. Nope. It's actually created out of thin air by commercial banks every single time they issue a loan. I know, it sounds wild, but those numbers you see in your bank account, that's not just a record of money. That is the money. That's the main component of the money supply. All right, so how does this magic trick work? Let's walk through this bank deposits multiplier. Say you deposit £1,000 into Bank A. The bank can't just lend out all of it. It has to hold some back for liquidity, let's say 10%, so £100. But then it lends the other £900 out to someone else. Now that borrower doesn't just sit on the cash, right? They spend it. And whoever they pay that money to, they deposit that £900 into their bank, Bank B. And what does Bank B do? Same thing. It holds 10%, £90, and lends out the rest. And this process just keeps repeating, on, creating new deposits and new loans all across the system. And here's the final result, the big reveal. That one single initial £1,000 deposit with a 10% liquidity ratio, it can end up creating a total of £10,000 of money in the economy. That is the power of the multiplier effect. It's kind of magic. But as we saw in 2008, it's also where the danger lies. The banking system isn't just holding money, it is literally creating it.
Now, if you thought that money creation engine was already powerful, well, in the years leading up to 2008, a new financial innovation came along and just poured gasoline on the fire. It was called the securitization chain, and it put everything into overdrive.
So what exactly is securitization? Well, in pretty simple terms, it's a process where a bank takes an asset, like a home mortgage, bundles it up with thousands of other mortgages, and then turns that bundle into a new product, a security, like a bond that they can sell to investors. Now, why was this such a game changer? Think about it. The bank makes a loan, sells it off, and instantly gets its cash back. That means it's free to make even more loans and start that whole money multiplier process all over again, but way, way faster.
It basically became this giant financial assembly line. Here's how it worked. Step 1. A bank, the originator, pulls together thousands of mortgages. Then it sells that whole pool of loans to a totally separate company, a special purpose vehicle. Step 3. That SPV bundles them all into a new, pretty complex bond called a CDO. And finally, that CDO gets sliced up into different risk levels and sold off to investors all around the globe. We're talking pension funds, other banks, you name it. All of a sudden, a mortgage payment from a family in, say, Ohio was fueling investments in London and Tokyo. The system was completely interconnected.
But, and this is the crucial part, here's the fatal flaw in the whole system. As this quote points out, when the original bank knows it's just going to sell the loan and pass the risk on to someone else, well, it has way less incentive to be careful about who it's lending to in the first place, right? I mean, why worry about the risk if it's not going to be your problem? Economists call this moral hazard. The only real incentive was to keep that assembly line moving fast, and that led to more and more risky, subprime mortgages being handed out and then packaged up and sold. The entire global financial system was being built on these incredibly shaky foundations.
So, when that house of cards inevitably came crashing down, it forced a global reckoning. There was no other choice. Regulators and governments all over the world had to step in, not just to stop the immediate bleeding, but to try and build a stronger, more resilient system for the future.
And a key part of that response was the role of central banks. They had to step up and become the lender of last resort. I mean, total panic had set in. Banks completely stopped lending to each other because nobody knew who was safe and who was about to go under. The whole system was seizing up. So central banks like the Fed in the US had to pump trillions of dollars into the system, basically just to keep the lights on and prevent a full-scale economic meltdown.
The main long-term regulatory response was this new global rulebook called Basel III. Now, the details can get super complex, but the main goals were actually pretty straightforward. First, force banks to have much bigger financial cushions, more of their own capital, so they can absorb losses themselves and taxpayers don't get left with the bill. Second, make them hold more high-quality liquid assets, cash for emergencies, so they don't get caught out like Northern Rock did. And finally, put even tougher rules on the biggest, most important banks, the ones whose failure could literally bring the whole system down with them.
And all of this, it leaves us with a big, lingering question. We've definitely built higher walls and deeper moats around the financial system. But are some of these financial institutions still too big to fail? Are the biggest banks today truly safer? Or have they just gotten so massive that, despite all the new rules, their failure would still threaten to take all of us down with them? Honestly, it's the question that probably keeps regulators and a lot of other people up at night.